If you're a dividend investor, regardless if your focus is on growth or high income, then you should be buying SCHD. When it comes to investments that offer both incredible dividend growth and safety, it's unlikely that anything can beat this particular ETF. Even comparing it to its peers, including the Vanguard Dividend Appreciation ETF, the iShares Core Dividend Growth ETF, and the Spider Dividend Appreciation ETF, SCHD is the undisputed champion. Charles Schwab also announced 2 days ago that this quarter's dividend payment would be a sizable increase compared to the previous quarter, and this is going to be the second largest dividend payment SCHD has ever issued. In this video, we're going to take a look at the successful strategy that SCHD has used that's provided investors with excellent long-term growth. We're also going to look at all the things that sets them apart from their competitors in this field. Also, if you happen to be like a lot of my viewers who prefer the higher yielding investments like I normally do, I'm going to try to convince you that you should also consider adding at least some SCHD to your portfolio. And just FYI, I'm not sponsored by Charles Schwab in any way, I'm just a big fan of this dividend fund. Let's start off by looking at this ETF's latest dividend distribution. On December 11th, Charles Schwab announced that SCHD would be paying 26.45 cents per share in the fourth quarter of this year. This is their second largest dividend ever after you adjust the previous dividends for the recent stock split that took place in October. This represents a 5.16% dividend increase from 3 months ago, and it's also an increase from Q4 of last year. SCHD's strategy is pretty straightforward. It tracks as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. In order to be included in that index, a stock must have sustained at least 10 consecutive years of dividend payments, have a minimum float-adjusted market capitalization of $500 million USD, and meet minimum liquidity criteria. The index components are then selected by evaluating the highest dividend-yielding stocks based on 4 fundamental base characteristics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Despite including the highest yielding dividend stocks, the index does not include real estate investment trusts, master limited partnerships, preferred stocks, and convertibles. So in a nutshell, SCHD picks some of the highest yielding stocks out there as long as they have 10-year dividend track records, are large enough in market cap, and they have good liquidity. What this has resulted in is a dividend growth ETF that offers a significantly higher yield than any other dividend growth ETF. As of the making of this video, SCHD offers a 30-day SEC yield of 3.6%. All of their competitors, including VIG, DGRO, VYM, and SDY, yield significantly less. The next best yield is offered by VYM at 2.49%, but this offers very little dividend growth. Speaking of which, SCHD has the best dividend growth out of all the other dividend growth ETFs that exist. Seeking Alpha currently gives them a 5-year dividend growth rate of 13%. You'll have a hard time finding another similar ETF that's delivered these kinds of gains in their distributions. You'll probably find something like this Invesco S&P Small Cap Energy ETF that claims to have really high dividend growth, but if you look further, you'll see that all of these dividends appeared very recently. They don't have the decade-long growth streak of SCHD. Speaking of which, according to Schwab's website, this ETF has delivered an average annual return of 13.61% since its inception in 2011. This beats out every other dividend growth ETF that I've mentioned up to this point. None of them have provided average yearly returns like this. The historical yearly return of the S&P 500 is around 9 to 10% per year. So the fact that this fund has been doing much better is obviously a really impressive sign. Then there's also the low expense ratio. This is how much money you're charged to invest in a fund. SCHD currently comes with an expense ratio of 0.06%, which is tied for the cheapest dividend fund. It's tied with Vanguard, the leaders of the low-cost index fund movement with Jack Bogle. Both VIG and VYM also come with expense ratios of 0.06%, or 6 basis points. And remember, neither of these funds have delivered the same returns that SCHD has. So to summarize everything we've looked at, the Schwab Dividend ETF has provided the best return since its launch more than a decade ago. It offers the highest dividend yield, it offers the highest dividend growth rate, and it's one of the cheapest dividend ETFs available to investors. These are all the reasons why I'm convinced SCHD is the best choice for adding dividend growth to your portfolio. But now, what about people who prefer income investing? Why should someone who likes BDCs, covered call funds, and REITs consider SCHD with its 3.6% dividend yield? Why not just stick with an ETF like JEPI or SPY? After all, they both offer diversification, have high yields, and they pay monthly dividends. The main reason why I recommend SCHD is because of dividend growth. Diversification and share price appreciation are really important too, but it's important to think about the distribution growth. JEPI's dividends largely depend on market volatility. You can see from their dividend history that they can swing pretty significantly from one month to another, making it somewhat unpredictable if you're trying to plan a budget. And SPY does offer dividend and share price growth, but it's just nowhere near as fast as SCHD. And so my fellow income investors ask me all the time, why even bother with this fund given its small yield? And I always ask them to imagine a situation. Let's say you do achieve the goal of living off dividends when you're 50 or 40 or whatever age. You're making $4,000 or $5,000 a month in dividends. While that is amazing, how far do you think that money will get you in 20 or 30 years? Inflation is going to eat away at your monthly income as time goes on. Historically, inflation's nowhere near as bad as it has been these past several years. But if you plan on living for many more years, which I hope you do, then SCHD is going to help ensure that once you retire off dividends, that you can stay retired off dividends. Now, if you have other sources of income, like let's say you have a couple rental properties, or you have a pension that you'll eventually add to your monthly income, then SCHD might not be necessary. You could also hope that Social Security will still be around when you choose to start it, but there's obviously been a lot of speculation that it might not be around in a couple years, given how unsustainable it's been. If you happen to be in your 90s, then that might be another situation where SCHD might not be a big priority. Because the truth is, if you're living off dividends, then you're not reinvesting them. That's the primary way of growing your dividends with these high-yielding investments if you're not living off them yet. And with stocks and funds that offer yields of 8% or more, they typically don't come with significant dividend growth. There are some holdings that do offer consistent growth, including Realty Income and Main Street Capital and Agree Realty to name a few. But unless you hold a substantial number of shares in each of these holdings, you're not going to notice that big of an increase in the dividends compared to SCHD. With this particular ETF, you can own less shares of it and still get faster dividend growth in your portfolio. If you couldn't tell, I'm really hoping that if you're exclusively an income investor, that you'll at least consider adding some of this ETF or a similar holding. The truth is, if you prefer an alternative to SCHD, like VIG or DGRO, then there's nothing wrong with either of them. All of these ETFs have delivered really great returns since their launch, even if they have been slightly less. From a dividend perspective, if you do want that higher yield, then SCHD is going to be the way to go. VIG is a lot more diversified when it comes to the number of holdings that they have, but so far it hasn't really benefited them from holding this many positions. Any of these dividend growth ETFs are also going to be better suited for you if you're more risk averse and you want lower taxes. You can bet that if SCHD is currently nosediving, then the whole market as a whole is likely doing the same since it's exposed to so many sectors. 100% of SCHD's dividends are qualified dividends, meaning that you don't have to pay taxes on them in a non-retirement account up to a certain amount. I know this ETF gets a lot of hype here on YouTube, but the results speak for themselves. And with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.